For years, Australians soaked up record low interest rates and easy credit. Now, with inflation stuck at 3.8%, what was meant to be a year of relief may turn into a financial shock. The nation's top banks are warning that the next decision by the Reserve Bank of Australia could reverse course and squeeze thousands of families an extra $5,000 a year. If you think the pain will hit evenly, think again. There are suburbs about to bear the brunt, and most people do not realize how fast their situation could change. So why is the Reserve Bank of Australia preparing a move no one saw coming, and who is most at risk? In November 2020, the Reserve Bank of Australia slashed the cash rate to a record low of 0.10%. The country was deep in the uncertainty of COVID-19 lockdowns, and the Reserve Bank of Australia's move was designed to keep the economy afloat. Mortgage lenders responded by rolling out fixed rates as low as 2%. For millions of Australians, it felt like an open invitation to borrow. Households locked in cheap loans, confident that the era of easy money would last. The message from the top was clear. Reserve Bank of Australia Governor Philip Lowe publicly stated rates would not rise until at least 2024. That promise shaped the decisions of families, first home buyers, and investors alike. Property prices surged as buyers raced to secure their place in the market. In Sydney and Melbourne, homes changed hands at record prices, with demand spilling into outer suburbs and regional areas. Banks approved loans at record volumes, often at high loan-to-value ratios, as buyers stretched to meet soaring prices. The belief that repayments would remain manageable fed a housing boom that few thought could end abruptly. But the landscape shifted in May 2022. The first rate hike in over a decade landed, catching many off guard. What followed was one of the most aggressive tightening cycles in Australian history. Over the next 18 months, the Reserve Bank of Australia delivered 12 consecutive rate increases. By late 2023, the cash rate had climbed to 4.35%. For borrowers, monthly repayments ballooned. Fixed-rate loans began to expire and rolled over to much higher variable rates. The safety net that so many had counted on vanished almost overnight. By the end of 2025, the Reserve Bank of Australia had eased rates back to 3.60%. Many assumed the worst was over and that a steady path of cuts would follow, but the scars of the rapid tightening remained. Households that had borrowed at the peak of the property frenzy found themselves exposed, with little buffer against further shocks. The stage was set for the next surprise, a sudden reversal that would test the resilience of families, investors, and the housing market as a whole. Headline inflation surged to 3.8% in the December quarter, catching policymakers off guard. Core inflation, stripped of the most volatile items, landed at 3.3%, both readings uncomfortably above the Reserve Bank's target band of 2 to 3%. The cost of housing and rent led the charge, with new dwelling prices and electricity bills pushing household budgets to the brink. Despite earlier expectations of rate relief, the latest data forced a sharp rethink inside the boardrooms of Australia's biggest banks. Labour market figures added fuel to the debate. Unemployment slipped to 4.1% in December, a level last seen during the early days of the post-pandemic recovery. Wages continued to climb, and consumer spending rebounded through the Christmas period. Economic growth forecasts now point to a robust 2.4% for early 2026, signalling an economy running hotter than most had predicted just months before. Within hours of the inflation numbers, bank economists recalibrated their forecasts. Belinda Allen, head of Australian economics at Commonwealth Bank, said, "The economy has picked up more momentum than expected. A small rate increase in February would guide inflation back toward target." Commonwealth Bank officially tipped a quarter-point hike, a call echoed by ANZ and NAB. Westpac analysts declared, December quarter inflation had the casting vote and voted yes, hike. Their base case now anticipates the cash rate rising to 3.85% after the Reserve Bank's February meeting, with the door left open for further increases if inflation refuses to budge. But not everyone is convinced a hike is the right move. Some economists, often called the doves, argue the Reserve Bank should hold steady. They warn that another rate rise could snuff out the fragile recovery in household spending and risk tipping the economy into recession. These voices point to a downward trend in underlying inflation since the middle of 2025, suggesting that the recent spike may prove temporary. They urge patience, citing the lag between monetary policy changes and their impact on the real economy. The debate has now reached a fever pitch. On one side, the banks and their economists see a necessary correction to keep inflation in check. On the other, a growing chorus warns of the dangers of over-tightening. The only certainty is that the Reserve Bank faces a decision that will ripple through every mortgage and rental agreement in the country. For millions of households, the outcome will be felt not just in abstract economic statistics, but in the monthly struggle to keep up with the cost of living. Western Sydney's mortgage belt is facing a pressure cooker moment. In postcodes 2, 1, 4, 5 and 2747, families who locked in low fixed rates during the pandemic are now staring down a monthly jump of up to $1,708 as those deals expire. About 30% of borrowers in these areas are rolling off their fixed rates right now, with little financial buffer left after years of rising living costs. For many, the move to variable rates is not just a technical adjustment. It is the difference between making the mortgage and falling behind. The pain is not limited to Sydney. In Melbourne's west, unemployment sits at 6.2%, and household incomes lag behind the city average. Borrowers here took on large debts during the boom years, often with debt-to-income ratios far above safe levels. The risk is especially acute for first-home buyers in the outer growth corridors of Brisbane and Perth, where 95% loan-to-value ratios are common. These buyers, many with only a 5% deposit, now face the threat of negative equity, owing more on their homes than they are worth if prices slip or payments rise again. The numbers on a spreadsheet translate to real stress in living rooms across the country. For these communities, a 0.25% hike is not just a headline. It is another blow to families already stretched to breaking point. Mortgage stress is no longer just a suburban story. If the Reserve Bank lifts rates by 0.25 percentage point, nearly 1 in 3 Australian mortgage holders, 31.4%, will be at risk of financial distress. That is the highest level since the 2008 global financial crisis. Sydney's median house price stands at $1.76 million, a figure that now locks more families into repayments that swallow up the majority of their income. As borrowing power drops, the property market faces new pressure. First home buyers, already stretched thin, may be forced out of the market entirely. Even stable households could find themselves on the edge if living costs keep rising. Business insolvencies are climbing, up 39% year on year, as retailers and small firms struggle to keep pace with falling consumer demand. 3 futures are possible. One option is a single rate hike followed by a pause, which could steer the economy to a soft landing. Another option is multiple hikes, which would risk a wave of defaults and falling home values. A third possibility is a surprise hold, which might offer temporary relief but would leave inflation unchecked. The stakes now reach far beyond any one postcode. Every dollar counts when rates move. Start by running the numbers. For every $100,000 you owe, a 0.25% rate rise adds roughly $50 to $60 a month to your repayments. Multiply that by your loan size, don't guess. Get the exact figure from your lender or an online calculator. Next, reach out to your bank before the decision lands. Ask about rate lock options or whether you can switch to a better deal. If you are worried about making payments, banks are required to offer hardship assistance. This could mean interest-only periods or temporary payment pauses. Build a buffer now if you can. Aim for at least 3 months of repayments in savings and cut back on non-essential spending immediately. If you are considering refinancing, compare offers today. Waiting even a week could mean higher costs if the RBA hikes. The next 48 hours are not just about bracing for bad news. They are your window to take control, before the banks make the first move. Every 0.25% rise means thousands more families face real financial pain. Now, not months from now. As the Reserve Bank of Australia weighs its next move, the cost of living crisis tightens its grip. The question is, who absorbs the shock, the markets or the people? Share your thoughts below.